This is the 2019 company question, Linken Limited. This is actually kind of a difficult enough question in terms of company, or even question ones themselves. This is probably one of the more difficult ones that have previously come up. So just going to go through the notes again. This is the normal trial balance. First note here, there's variation of what we've seen before, but it's the same thing. Stock is this 75,400. It includes damaged stock, which costs 6,000, but is now a net realizable value of 75%. What does that mean? There is a piece of stock that cost 6,000, and it has dropped its value to 75%. That's obviously the cost figure, so it's just 75% of this that is the new value. So what does that mean is essentially 25% of it has been damaged. So I need to take 25% away from my closing stock. So the 6,000 is the cost. It's dropped its value 75%, dropped its value down to 75%, which is 4,500. So that's its new value. It was 6,000, now it's 4,500. So it's reduced its value by 1,500. That's a 1,500 reduction in value. Therefore, my closing stock, which was 75,400, now has to lose 1,500 because that was damaged. So this is my new closing stock figure. But there's more changes for closing stock later on, so I'm not going to put that into my final counts yet. Now, number 2, during the year, stock which had cost 7,000 was destroyed by fire. The insurance company agreed to pay compensation of 5,100. I know if I destroy my stock during the year, I take from purchases. Remember, closing stock is only when people go into the store at the very last day and count the stock. So if it was damaged during the year, it's obviously never made it to that final stock check count. So 7,000 is gone from my purchases. Take away 7,000, down to 1,038,000. What else do we need to do? We need to find out whether we have been fully compensated or not. So the stock, which it cost 7,500, has now I suppose we're being agreed to being paid 5,100, so that's current asset. They agreed to pay. So that 5,100 we haven't received yet. So the value of the stock was 7,000. We're going to receive 5,100. Therefore, there is 1,900, which is going to be a loss by compensation, loss by fire. And that goes in as expenditure for admin because again it's to do with the insurance loss rather than the loss in stock. So the 5,100 is current asset, 1,900 is expenditure, admin. Note 3, little spin, I suppose just a change in terms of what we've seen here. This is not too difficult once you break it down, but on first sight it can appear a little strange. Cost of delivery vans is to be written off on a straight line basis over 5 years. A full year's depreciation is to be charged in year of acquisition and none of the year of the disposal. Delivery vans have 5% scrap value of the original cost. So they're not going to tell you what the depreciation percent is. They're not going to tell you it's 10%, 15%, 20%. You have to work it out. So a couple of things I'll just go through just before I get into it. Delivery vans are going to be written off over a straight line basis, so over cost. All that means is that the depreciation each year is going to be the same. But it's to be depreciated over 5 years. So if you think about it, if you're running a company and you bought 10 delivery vans, in 2020, the delivery vans are only going to last you 5 years. They're depreciated over 5 years and then they're down to their scrap value. So yeah, we'll get to that in a second. Small bit of kind of note here for later on. There's a full year's depreciation in year of acquisition and none in the year of disposal. That means we won't be messing around with months. We won't say we had it for 3 months of this year and 5 months of the year we sold it. There's a full year's depreciation whenever the year we buy it, and whereas no depreciation in the year we sell it. So the delivery vans have a 5% scrap value of the original cost. So that does not, basically, once it's fully depreciated, it's down to 5% of its value. That does not take part in the depreciation. So a couple of different things we can do just to go through, but we're going to use the example they've given here. We'll just stop at the first line. During the year, a delivery van which had cost 25,000 in 2016 So the delivery van costs 25,000. So how do I calculate its depreciation? So a couple of things. Um, just to kind of explain it, we're not going to do it this way, but the 25,000 is the 100%. It's the cost. And we know that after 5 years, it's going to be fully depreciated down to its scrap value, which is going to be 5%. Therefore, it starts at 100%, and after 5 years, it's down to 5%. So the depreciation for 5 years is going to equal to 95% overall. So if you wanted to, you could get 95% divided by 5, which would work out at 19. And that 19 would be your depreciation for the year. That's not shown in the marking scheme. That's just a way for you to kind of wrap your head around it. I probably would just go with the method I'm going to show you, but you could do either or. So obviously the cost is here. There's a scrap value at the end, and that's what it's worth when it's just we've stopped depreciating it. That's what the parts are worth. But in order to get from the 100% to 5%, we need 5 years depreciation. And it's going to be equal depreciation over those 5 years because it's a straight line. So what way do I recommend you to go through working it out? Well, the cost is 25,000. This is just looking at the disposal part first. And the scrap value is 5%. So if I work that out here, 25,000 by 5%, I can get 1,250. That's the value after 5 years. Value at the start, 25,000. Value after 5 years, 1,250. So the depreciation is going to be the difference between the cost and the scrap value. So 25,000 minus 1,250 is 23,750. That's my 5 years depreciation, 23,750. Did we depreciate it for 5 years? Well, the van had cost 25,000 in 2016. And then had it been traded in. So how many years depreciation do we need on it? Well, we know that we bought it in 2016. This is the 2018 question. Well, we're looking at the year 2018. So 16, 17, and 18, it would appear like there's 3 years depreciation. But remember, there's a full year's depreciation in year of acquisition, 2016, and none in the year of the disposal. So we disposed of it in 2018 because that's the year we're doing the question for. We're looking at all of 2018. So the 2016 is a full year's depreciation, year of acquisition. 2017 is a full year's depreciation, and 2018 has none. So we're actually going to depreciate it for 2 years. So it cost 25,000. The scrap value was 1,250. Therefore, depreciation over 5 years would be 23,750. But we didn't have it for 5 years. We only lost 2 years depreciation on it. So divided by 5 multiplied by 2 is 9,500. You could also do, as I said, 25,000 is equal to 100%. The scrap value is 5%. Therefore, 5 years depreciation is 95%. Divide the 95% by 5, and you get 19% depreciation per year. You can do either or, but that's just shown out there. So your cost, you get your scrap value. The difference between cost and scrap value is going to be the depreciation. That's equal to 5 years. And in this case, we're only looking for 2 years depreciation there, because that's all we had it for. We're not going to depreciate it for the years we didn't own the van. That would make no sense. So now we can go back to our normal way of dealing with this note. We'll look at the disposal first. The cost is 25,000. We know that we've lost 9,500 depreciation on it, so the net book value was 15,500. A lot of marks going for this, by the way, because this would have been obviously difficult for people to get. So 15,500 is the net book value. We know we received proceeds of 14,000, was traded in for 14,000. Therefore, there was a loss. Valued it at 15,500, only received 14,000 for it. We made a loss of 1,500, loss in disposal. That is a selling and distribution expense. Next thing we're going to look at here is going to be the cost. So cost of the first for vans was 155,000. So the cost is 155,000. I know I've disposed of a van worth 25,000, and I bought a van worth 40,000. So a new van costing 40,000. So my vans at the end of the year is going to be 170,000. Now, depreciation for the year. Depreciation for the year, I just know that 170,000, it's the same process. 170,000 is going to be my cost. It's 100% because that's the value of my vans at the end of the year. That's the 100%. It doesn't take into account the disposal because there's no depreciation on it. So that's the vans that I've had for the year. Remember, there's a full year's depreciation for a year of acquisition. So this 40,000 is going to be depreciated for the full year. This 25,000 is not going to be depreciated at all because there's no depreciation in your disposal, and we've had this all year anyway. So it's only going to be one thing I'm going to do to calculate my depreciation for the year. It's the value at the end of the year is 170,000. That's equal to the 100%. So we know the scrap value is 5%, but we know that the depreciation over 5 years is 95%. So 170,000 multiplied by 95% gets us the full 5 years depreciation, 161,500. I divide that by 5 and I get the depreciation for 1 year, 32,300. Again, you can also say 170,000 is equal to the cost. Once I take away the scrap value of 5%, I know that my depreciation is 95% for 5 years. If I was to divide 95 by 5, you get 19. So there's 19 depreciation, 19% depreciation per year. 170,000 multiplied by the 19% would get me my 32,300 as well. Finally, the depreciation at the first of the first is the difference between cost and net book value. It's 35,000. I know my depreciation for the year was 32,300, and I know my disposal depreciation, which now has to go out of the accounts, was 9,500. Therefore, my accumulated depreciation on my balance sheet is 57,800. That may not be clear on the video, but it's 57,800. And what's the last thing I need to do for all these questions? We're told that the check for the net amount of this transaction was incorrectly treated as purchase of trading stock, was entered correctly into the bank account. So what do I need to do here? I need to take out the check for the purchase of the new van. The new van cost 40,000. We received a discount of 14,000. Therefore, we only paid 26,000 for it. It shouldn't have been included in purchases. So I'm going to come back here. This is my purchases from note 1. And this is here again for this note. I'm going to take out the 40,000 new van, take away the proceeds of 14,000. We paid 26,000 for this new van. Shouldn't have gone into purchases, so I'm going to take it out of purchases here. My purchases figure now is down to 1,012,000. So this is just the normal taking out the check for the new van. Ignore this. This is just a copied and paste image from above. This is part of note 2. Note number 4. So discovered that goods have been sent to a customer at the end of the year on a sale or return basis. So I sent goods to a customer, which means I intended on selling to them. But it's a sale or return basis. That means the customer actually gets to get the goods first, and then they decide whether they want to buy them or they can just return them. But when it's a sale or return basis, I actually don't put this through as a sale until the customer says, yeah, I'm actually going to buy it. And they haven't told us that yet. So this shouldn't have been put through as a sale, but it was. The goods are entered into the books as a credit sale of 7,500, which is a markup of 20%. So I need to basically just take this sale out of my accounts. I need to just erase the sale and pretend it never happened. So, because it officially hasn't happened yet. So what accounts are going to need to be changed? Well, first of all, the goods were sent to the customer the 31st of the 12th. That means when I counted the closing stock at the end of the year, these goods wouldn't have been in the warehouse. But technically we still own them. So we know closing stock is going to be changed because technically we still own those goods even if they're not in our warehouse. We still own them. So I need to add these goods onto the closing stock. It had been entered into as a credit sale, which means it shouldn't have gone through as a sale, so I need to reduce my sales. And obviously because I entered it as a credit sale, I would have charged it to debtors. And I need to take that out of debtors because they could easily just turn around and say, you know what, we'll just return the goods, we don't want to buy it. So the 7,500 is the includes the markup on cost of 20%. This is the retail value, it's the sale value. So I know when I deal with this, I have 3 accounts. I have my closing stock, I have my sales, and I have my debtors. Because I put it through as a credit sale um, of 7,500, that was the amount that I charged to my debtor, and it was the amount that I put through as sales. So that's the amount I'm going to take out of both of those accounts. My sales figure from my trial balance is 1,590,000. I'm going to take away the 7,500 here because this sale didn't happen. Hasn't happened yet anyway. So my sales is now brought down to 1,582,500. My debtors, given in the trial balance, is 98,200. I've charged them the sales value because obviously debtors pay for the sales value. So I'm going to take out the 7,500 again because this was incorrectly treated as a credit sale when it was actually a sale or return basis, i.e. we haven't sold it yet. So I take out from sales and I take out from debtors the full retail value, sales value figure. But for closing stock, I'm going to take out the cost. I'm going to look at the cost value. Because I haven't sold this yet, this is something I still own. I still own the closing stock. I still own this as stock. It wasn't in the warehouse of the 31st of the 12th because it was gone. So this was not included in my closing stock tally, but it should have been. 7,500 is cost plus 20%. So when I'm looking at closing stock, it's at cost value. So my 7,500, I divide by 120% multiplied by 100 gives me 6,250. So 6,250 is my sales value, that's the 100%. And I'm going to add that onto closing stock. I'm not going to take the closing stock figure from up here because remember we changed it to 73,900 in note number 1. So 73,900 note number 1 plus 6,250. Because I'm adding this back to closing stock, it should have actually been in my warehouse at the 31st of the 12th because I still own it. So my closing stock figure that I can put through in my trading profit and loss and my current assets is 80,150. Okay, next note. Again, they've kind of changed this around a small bit, but in the wording, but it's the same. Patents are to be written off over a 5-year period commencing in 2018. So it looks like we can go ahead straight away and just divide patents by 5 years. But if we go up to the trial balance, it tells us here that patents incorporate 5 months investment income. So this is actually the same as the previous questions we've looked at. They just didn't tell us at the bottom, but they've told us here. So I know I need to take out those 5 months investment income before I touch the patents written off figure. So investment income 5 months. Well, I need to find my investments here. It's 3% of 360,000, but we got them on the 1st of the 4th. So I'm going to go down to my investments here. The 360,000, by the way, came after the 3 months of this year had gone. So technically, I'm going to depreciate this fully at 3% for 9 over 12. So investment income for the year is 360,000 multiplied by 3% by 9 over 12, which is 8,100. So that's for 9 months. But I know that my patents only includes 5 months. So if 8,100 is 9 months and I want 5 months for patents, I need to get 5 over 9 of 8,100. So 8,000 multiplied by 5 divided by 9, which is 4,500. The reason I'm dividing by 9 and not 12 there is because 8,100 only represents 9 months. So I'm trying to divide 5 months here and take this from patents because it's already been, I suppose, already been received. And the other 4 months then is going to be due at the end of the year. We'll get to that later on. If you wanted to, you could just ignore the date for now. And you could just say 360,000 by 3% multiplied by 5 over 12. You could do either or. I'm just showing you this because we'll be looking at this later on. But anyway, the 5 months is valued at 4,500. So my patents is 43,500 here. I'm going to add on the investment income to get rid of it, 4,500. So my total patents figure, excluding investment income, is 48,000. So 48,000, I'm going to write this patents off over how many years? Tell us here, over 5 years. So 48,000 divided by 5 is 9,600. So that's what I'm writing off per year. So it's patent written off. It is 9,600. It's expense, it's admin. paid and written off as an admin expense. And obviously when I'm doing my intangible fixed assets for my balance sheet, I need to take this off because this has been written off from my accounts. So my 48,000 minus the written off this year is 38,400. That's my balance sheet figure. This is the same as what we've dealt with previously. It's just it wasn't worded at the bottom. It was just shown in the trial balance. So 38,400 is my paid-ins figure for my intangible fixed assets in my balance sheet, and I'm going to take 9,600 as an admin expense for patent written off. We'll look at the investment income due again later on. This is shown at the bottom. Next note we have here is the suspense note. So this is more or less similar to what we've seen before, just a slight change in months. Suspense figure results from an incorrect figure for debenture interest, same as normal, and then we've discount as well. So I'm going to look at my debenture interest figure. They've shown us here debenture interest paid was 6,400, but we know this to be incorrect. So we need to find the correct one for how many months? 3. So we're following the months that they gave here. So if I look at my debentures, what's interesting here is that, and we've seen this before once in Sole Trader, my debentures is 300,000, but if you look closely, after 3 months we got 60,000 debentures. So for the first 3 months, that 60,000 wasn't there because this was only issued on the 1st of the 4th. Debentures, remember, is a loan, so we were issued with an additional 60,000 euro loan essentially in April after the first 3 months had taken place. We're only looking here for the debenture interest for the first 3 months. So that means the 60,000 shouldn't be included. So it's 300,000 minus 60,000 is 240,000 was my debenture figure for the first 3 months. 240,000 multiplied by the 7% return multiplied by 3 over 12. And that's shown here. 240,000 by 7% by 3 over 12 is 4,200. That's my correct figure for debenture interest, but it was shown as 6,400. So 6,400, it should have been, the actual figure is 4,200. So I have to cancel 2,200. Bring that over to my debit side of my suspense account, which is salaries. 243,100 is my salaries amount. I'm cancelling the 2,200 euro for debenture interest. Now, looking at the second part of this note, we can see it is on discount. Discount received 460 entered only into the creditor's account. So, discount received. I'm receiving a discount from my creditors as people I owe money. So this is a form of income. I owe my creditor a certain amount of money and they're giving me a discount on it of 460. I'm receiving this discount. Therefore, this discount is income. So in the discount account, this will be income. It will be on the credit side of the account. It's 460. So my discount account here, the figure given is 15,500. So I can see that if I do this in a T account, the 15,500 is the balance. And I've gone and I've increased the income amount because I've received a discount of 460. Therefore, that's my final discount figure, 15,960. That will be my operating income. I'll be adding it there as discount. Another way just to talk through this, if you're finding that a little bit confusing to understand, we'll deal with this in terms of thinking it through from a creditor's perspective. So my creditor account would be shown, quickly show it to the side. So this is my creditor account here. The balance will be up here, whatever the balance would be, because we owed it's a liability. So whenever we receive a discount, we'd be reducing this balance. So if I received a discount, let's say of Z here, it's a little messy. So my balance here, whatever was 100,000, I received a discount of 460. I'm reducing that balance. So therefore the discount itself, and I'm just going to call this D for discount. The discount itself will be on the debit side of the creditor's account because I'm reducing the amount that I owe my creditors. And we know with double entry, if it's on the debit side here for the creditor's account, then it has to be on the credit side of my discount account. But if you're thinking it from a discount account perspective, let's erase this here. If you're thinking of it from a discount account perspective, just simply think of it in the sense that Okay, so for discount, I know that if I'm receiving a discount, it's like an income. I don't owe that money at all. I don't need to spend that money. So income is the credit side here. So for a discount account, you look at it in terms of where it goes in the accounts. It's credit side, so 460. I'm going to add that here, 15,960. Another way for you just to try to understand this, for discount, this means that you have received discount. This means that you have given a discount. You've more or less, I suppose, allowed a discount. I don't know why I call it discount allowed, because it's only discount allowed if we have a debit figure. This is discount received. It's an income. Note 7. The company revalued buildings 975,000 at the first of the first. Land element of this was 150,000. The revaluation is yet to be included in the accounts. Building are depreciated at 2% per annum. A couple of things you need to look at. I'm actually going to, the way I've done it here, I started off with depreciation, but I'm going to look at this first. So my revaluation reserve, if I'm to calculate this, because I know that they've just told me here that the revaluation is yet to be included into the accounts. So we revalued buildings at the first of the first. So my buildings at the first of the first were my buildings before the revaluation were 850,000. So a little messy, but that's 850,000 here at cost. There was accumulated depreciation of 55,000 on it. Therefore, they were worth 795,000 at the first of the first. Remember, we revalued them at the first of the first, so I don't need to actually take out the depreciation for the year yet, because it doesn't come into my revaluation reserve figure. So this was the cost, 850,000. There was accumulated depreciation on it of 55,000. Therefore, they were worth 795,000 at the first of the first. We revalued them up to 975,000. Therefore, there's a revaluation reserve of 180,000 financed by. Now, for the depreciation for the year, we need to look at the question again a little bit more carefully. The buildings were revalued to 975,000 at the first of the first. Therefore, this would be the figure that I would calculate depreciation off. But this figure includes 150,000 land. Land does not depreciate. It makes no sense. Land doesn't go through wear and tear like buildings would. The land is regrowth every spring, so it would make no sense if you think about it. Buildings depreciate over 10 years, and after 10 years they're worth a fraction, maybe a value of what they were previously worth. It wouldn't make sense for land, otherwise the value would drop, and after a certain amount of time it would be worth nothing. So land never depreciates. Buildings and land 975,000. If I take out the land of 150,000, I just get the buildings. Buildings are 825,000. So I need to depreciate buildings, and depreciation is at 2%. We're given it here, 2% of cost per annum. So buildings are 825,000. 2% depreciation gives me 16,500. That is my admin. It's my expense, my depreciation for buildings for the year. But it's also my balance sheet depreciation, because there's no depreciation before this year because we've wiped that clean with the revaluation. So this will actually be the depreciation in my balance sheet as well, and that will be the cost in the balance sheet, and therefore net book value will be 958,500 will be the difference. So cost and depreciation, and then you'll have to calculate net book value. We're nearly there. I can appreciate this is a long question, but again, it's difficult, and it's good to go through this question and for you to have it and to be able to look over something you're not sure of. Note 8, we've seen some of this before. This is our bank statement arriving, showing an overdraft of 62,280. Again, it's an overdraft, a negative that we owe money, but our own bank isn't consistent with that. These are the differences. This is a little bit different to what I've previously seen before. Just to go through it, so a check received from a debtor of 5,600 has been dishonored by the bank. This debtor has been declared bankrupt and has made a credit transfer for first and final payment of 30 cents for every €1. So usually we're not told this first line. We haven't previously been told that we've received a check but it's been dishonored. So what happened here? So debtors are people that owe us money. So we received a check from a debtor, which means obviously they don't owe us this 5,600 anymore. We would have reduced our debtors balance. But this was then dishonored by the bank, so that the bank cancelled the check. It didn't go through because obviously the debtor didn't have the money to pay for it. Um, so that means I'd add 5,600 back. That hasn't been done yet. So technically I'd need to add that back to my debtors. But then the debtor went on to say that, okay, I'm going to pay you 30% of it, and the other 70% we're going to write off as bad debt. So if you look here, I actually didn't do a debtor's account. I didn't bother. I'll show you why again with bad penmanship. My debtor's account here would have a debit balance, always a debit balance. If I received a check for 5,600, that means that I will reduce the amount that my debtors owe me. So 5,600 would have gone here. So that's already gone through. That had been put through in our accounts. But this had been dishonored by the bank. So this 5,600 that I had previously used to reduce the amount my debtors owe me has been dishonored. So I'd have to write this 5,600 again. I'm just going to write 5.6. I'd have to include that again to debtors. I'd have to add it back. What did they do then? They then went on and they said, okay, we're going to pay you 30% of this, and the other 70% is going to be, bad debt written off. So let's just pretend that 30% of it is worth 1,000. So they've reduced the value by the 30%. Let's call it 1,000. So just put in 1, because they paid it. But the other 70%, they're not going to pay. It's a bad debt. So because it's a bad debt, I need to write that out of the accounts as well. So I'm making up these figures here. But what's after happening is I'm after adding the 5,600 here to the debit side because the check has been dishonored, so I need to add that back to my debtors. But I'm then just going to go and cancel it because 30% of this has already been paid and the other 70% of it is written off. So essentially you're just writing 5,600 on either side. You're not changing the debtors balance. So some of you may have done that. You've previously changed debtors already in the note number 4 on the sale or return basis. So if you went and you changed that again previously, there was really no need to do that. So we're going to look at the first one just in terms of bank. So my bank in my accounts is 60,000 overdraft. So that's my bank figure here. It's a 60,000 overdraft. And what's after happening? Well, I'm cancelling a check because I didn't receive it. So therefore, the check would have been positive. It would have added money to my account, but I'm cancelling that now. So I need to take that away. Basically, if you were told or put in through your own bank account that you made for your company that you're going to receive 5,600, but if it doesn't come true, you then need to take out that 5,600. But then we went off and we received 30% of this debt. So 5,600 multiplied by 30 divided by 100 works out at 1,680. So I'm going to add this back because the debtor actually paid me this. Therefore, I received it. My bank balance has gone up. So my bank balance was negative, so it was minus 65,600. But I received 1,680, so I'm going to add this back. And that's all you do for the first part. The other part of this is the bad debt. What's going to go through is bad debt. Well, the check was worth, they owed us 5,600. You can see it down here. They owe us 5,600, and 70% of this isn't going to be paid. It's going to go through as bad debt. So my 30% that I did receive, that they did pay me, was 1,680. But this is the 70% that they're not going to pay me. So that has to go through as a bad debt, and that is selling and distribution. So this is quite similar to what we've previously seen. The only difference here being that we had to cancel the check here, and we actually didn't bother doing the debtors account just because it was going to be putting the same thing on either side. Second note here we're looking at is a direct debit, which means a payment to a local refuse company, so a local waste or KWD, anything like that, some form of a bin company or something like that, for €860 has not been recorded in the company's accounts. Um, so we sent a payment to a bin company essentially, or a waste company, for €860, and this hadn't been included in the accounts. So if I sent a check to somebody, obviously it's money I spent, it's going to be negative. I'm going to take that away from my bank again, further increasing the debt. My bank balance finishes in my own company accounts at minus 64,780. That is going to go in as a current liability, minus 64,780, because I'm taking away this because I sent a check. But what else do we do? So where here do I log? I need to log this as an expense as well. It needs to go in twice. So a payment for waste, there is no account for that. So what I'm going to do is I'm going to look for sundry or general expenses, and I can find that here. General expenses, I'm going to put in the payment to the refuse company. I'm going to put that in as a general expense. I'm not going to change this figure because I know I've already changed my general expenses in my suspense note. My general expenses here that I already changed to my salaries, I'm going to bring that down. So I could change it up here, but I'm just going to bring it down just to show you I have it down here. The original changes here are the first three. This is my balance. This was cancelling the first suspense. This was adding the discount for the second suspense. And now I'm going to go and further increase the expense here and expensing another €860 to my general expenses with salaries, because I'm just putting this here. Sundry or general expenses are where you just put the extras. So 860 here, it's an expense, so the debit side of the salaries and general expenses. So my final figure for salaries and general expenses is going to be 246,620. We're nearly there. The final one here again is the check which has not been presented, which means I'm going to go back to this figure and I'm going to change this guy here. My overdraft from the bank statement is 62,280. So 62,280 is my overdraft from the bank statement. We've gone and it says here there is a check for 2,500 which has not been presented, so the bank isn't aware of this. If I send a check, it further puts me into debt, so I'm going to take away another 2,500, which means my bank statement will now have an overdraft of 64,780. This doesn't go in anywhere, but I can see that now the two of these are balanced. So there's marks going for balancing them, but this does not go into the accounts. Only this goes in as a current liability because it's an overdraft. So I know I have that balance. That's the end of note 8. Last note. Provision should be made for both investment income due and debenture interest due. So we looked at these previously before. We saw with investment income, look at it here. My investment income, we saw that for the year, 360,000 by 3%, but we only had investments for 9/12 of the year. We didn't have it for the full year. So 360,000 by 3% by 9 over 12 is 8,100. That's my income figure. That's going to go in after my operating profit, because remember it's not operating. So profit on sale of land or investment income will go in after that and towards the bottom of my P&L. So 8,100 goes in there as investment income for the year. I've already received the amount that was included in patents. So in that patent note that we did up here, 4,500 was already received. So 5 months. So I can go back to this here. 4,500 has already been received. So what's left to be received from the 8,100 is 3,600. Just the full investment income for the year minus the investment income you've already received. 3,600 at the end of the year, which is still due to me. That's a current asset. My debenture interest, again, I've previously looked at this. There was 240,000 there for the first 3 months, and then a further 60,000 was added, so it's 300,000 for the remaining 9 months, all at 7%. So just to show this here, you could do two ways. You could say that 240,000 by 7% for the entire year, which is 16,800, and then just get the 60,000 for 7% for 9 over 12, which is 3,150. Or you could say 240,000 for 7% for 3 months, and then 300,000, which includes the full 2 months here, for 9/12 for 7%. Regardless, you're going to get 19,950. That's your debenture interest figure for the year. I didn't write that in there, but that should have gone in here as my expense. And this is an expense. I'm just going to say after. And this may not be very legible. I don't have a mouse or touch screen laptop. After operating profit. So my debenture interest expense, remember, isn't admin or selling and distribution. It goes in towards the bottom. 19,950 is my debenture interest for the year. I've already paid 4,200 of it. Remember, from the suspense note, we would have changed that. The actual amount that was paid out for 3 months was 4,200. So because I've paid this out already, my 19,950 minus 4,200. What's left, what's due at the end of the year is 15,750. That's the current liability. So that is due. It's a debenture interest due at the end of the year. Debtors. I've previously changed my debtors when I looked at the sale or return note. I could have changed them here for the bank note, but it wouldn't have made any difference. So if I go back to my sale or return note here, I can see that my debtors figure is 90,700. So 90,700, and I'm going to get provision for bad debt on that for 4%. 90,700 by 4% is 3,628. So I'm going to offset that from debtors because that's my new provision for bad debt. I have an old provision for bad debt. Always look for that. My old provision for bad debt is here at 4,000. So my old provision was 4,000. My new provision is 3,628. Therefore, I have a reduction. I've reduced my provision for bad debt. I've reduced the possibility of this expense. So that's a good thing. So I'm going to put this in as income. So reduced provision for bad debt 372 is an income figure, and it's part of operating figures. So that and discount will go in as operating income. The last part of this long question is my sorry, there's two small bits here. The managing director should be paid a bonus commission of 5% on all sales in excess of 1.2 million. Don't take the sales figure from the trial balance. Why? Because we changed sales already in note 4 for the sale or return basis. So in note 4 we changed sales to 1,582,500. So everything above 1.2 million, which is going to be 382,500, that is all going to be used for calculating commission. So my sales figure, which I've got from note 4, is 1,582,500. I know that everything above 1.2 million is going to be charged at for bonus commission. So if I take out the 1.2 million, I'm left with 382,500. I'm going to calculate bonus commission after that. It's at 5%. That works out at 19,125. That is a selling and distribution expense because it's commission to the managing director. But it also says here that the managing director should be paid. So they haven't been paid yet. We're not going to touch bank. We're going to touch current liabilities because they should be paid. Therefore, they haven't been paid yet. We owe this money. So this is a current liability. So there are creditors falling due within 1 year. So the 19,125 is a selling and distribution expense. It's also a short-term liability. Very last note tells us there's a transfer of 10,000 to be made from profit to the capital reserve. So I'm transferring that money. So my capital reserve here is already 45,000. I'm going to transfer another 10,000 away from my profit to this reserve account. So I'm just going to add another 10,000 because what I'm doing here is basically I'm taking 10,000 out of profits and I'm adding it to the capital reserve. So the capital reserve figure is going up 45,000, up 10,000 to 55,000. But this is also going to go into the P&L because I'm actually reducing profits by 10,000. So I'm going to need to reduce my net profit by 10,000. I'm going to show you that in a second. I did include this on that company guide Word document that I sent you. So that's where I expected you to be able to spot that. That guide is quite helpful. It goes through every kind of variation in terms of what you can see in these questions. So I'm hoping that you've gone through that before you did this question, just to spot that. Okay, trading profit and loss, nice and quickly. There are all the figures that we've put in so far. I have my sales, gross profit, my admin here, patents, salaries, depreciation of buildings, loss by insurance or loss on damaged stock. Remember, that's admin. My depreciation on delivery vans, advertising, remember that's selling and distribution. Loss on van, everything to do with vans is going to be selling and distribution. My bad debts is selling and distribution. And my commission to the managing director, my bonus commission, also here. Operating income, I have my discount. These are my two income figures that are operating. And reduction in bad debts provision. I've reduced the bad debt provision. The old bad debt provision was greater than the new bad debt provision. Then I have my other income and expenditure figures that are non-operating. They come after operating profit. So I have my investment income, the full 9 months was 8,100, and I have the full year's debenture interest of 19,950. Then I get my net profit, just like any published accounts or company question. I'm not done there. I need to take out dividends, but I'm also going to take out the transfer to capital reserve, because I have transferred 10,000 from profit. I need to take that 10,000 out of profit. So I'm also using this here. These are under appropriations. I'm taking out the dividends and I'm taking out the transfer to profit reserve, or transfer from profit to capital reserve. Two of these are coming out of profits, total 65,000. You don't need to add them together. You could have shown 55,000 here and then 10,000 after, but they both have to come after net profit. My retained profit is 162,967. My P&L balance from last year, which I can see up, where do we have it? P&L balance from last year here is on the credit side. That means it's income, which means it's positive. There was a positive profit balance last year of 71,500. Therefore, I'm adding that on to the retained profit from this year. Gives me a P&L balance at the end of the year of 234,467. That'll be shown later on. Again, intangible assets, my patents, what's remaining after what's written off. My buildings here include the revaluation amount for the first of the first, but they have the depreciation for the year here. My delivery vans cost depreciation from accumulated depreciation. Investments is a full amount. My debtors minus my provision for bad debt. I have my closing stock, investment income due, and compensation due from the fire, from the insurance company. These are all my current assets, my current liabilities. Creditors, commission due for, this is the bonus commission. Debenture interest, which haven't been paid yet. VAT, this wasn't adjusted at all, but again, if you look through your accounts, which you really do have to do, there are a couple of figures every single year in Sole Trader, in anything, incomplete. All these ones here, that there's information sometimes up at the top that isn't adjusted. 6,800 here was on the credit side. It's a VAT liability. I need to take that in, so please go through for your expenses, for your income, for your current assets, and for your current liabilities. You need to go through these to see is there anything that wasn't adjusted. So VAT is there. Bank overdraft we've already changed. That's my own bank figure. Finally, at the bottom here, I have my debentures. That's my creditors after 1 year. And then for capital and reserves, I have my ordinary shares, my preference shares. Authorized is shown at the top. Issued is shown in the middle of the trial balance. I have a revaluation reserve. My capital reserve, which is going to include the 45,000 from before this year and the 10,000 I transferred, and then my P&L balance. And finally, the balance. Difficult question, but one that's worth going through meticulously. If you are aware of how to do this question, it will be very helpful for your leaving cert.